Welcome to our deep dive into today's pre-market pulse. We've sifted through quite a stack of sources, global reports, earnings calls. We're trying to understand why the financial markets are flashing red right now. Our goal for you today is really to explore this, pretty concerning question. Can strong company fundamentals actually hold up against these, frankly, unprecedented political and geopolitical shocks?
Exactly. We're looking at quite a powerful cocktail here. Institutional tremors, trade wars, they're really dominating the landscape. Even while, some underlying corporate results look surprisingly robust. So yeah, get ready for maybe some crucial aha moments about how these big global events connect, directly to your world.
Okay, let's dive right into those tremors then. Our sources are highlighting two massive developments. They seem to be driving today's risk-off mandate. That's when investors get nervous and shift to safer assets. And the first one, it's a really unprecedented move coming out of Washington.
Yeah, what's fascinating here, and maybe a bit worrying, is the president announcing the removal of Federal Reserve Governor Lisa Cook. The reason cited involves allegations about fraudulent mortgage application information. Now, this isn't just political theater. It injects some severe institutional uncertainty. I mean, the market's suddenly questioning the Fed's political independence, right? Which is really a cornerstone of global financial stability. And you can see the reaction already. Investors are now pricing in an 84% probability of a rate cut in September, quarter-point cut. It just shows how quickly market expectations can pivot when, political influence seems to touch the central bank.
Wow. 84%. That's a huge swing and, yeah, a real potential curveball for central bank independence. And then sort of compounding that uncertainty, we're seeing another big flashpoint, this time in global trade.
Indeed. The Trump administration has formally announced an additional 25% duty on Indian exports. That brings the total tariff up to a pretty punitive 50%. And this action is explicitly linked to India continuing to buy Russian oil. So it's a clear weaponization of trade policy. We saw the fallout immediately. The Indian BSE Sensex index, it fell 1.04%. And the rupee, their currency, declined for a fifth straight session. Hit 87.78 against the dollar.
This session. Wow.
Yeah, and foreign investors, they pulled out over 2,400 crore rupees.
Which is about, $290 million US?
Roughly, yes. It's just a stark example, isn't it, how geopolitical risk turns into, concrete financial losses.
Okay, so with these two powerful headwinds blowing, how are global markets reacting more broadly? Our dashboard seems to show a pretty synchronized wave of selling, spreading right across the globe.
Yeah, the declines were quite widespread. Japan's Nikkei 225, down almost 1%. Hong Kong's Hang Seng shed 1.2%. France's CAC 40, though, that underperformed significantly, it slumped 1.84%. Seems amplified by its own domestic political instability over there. And meanwhile, the VIX index, the market's fear gauge, it surged to 15.51. So definitely signaling heightened investor anxiety.
And looking at other assets, we're seeing some classic risk-off signals, sure, but there's also this fascinating little wrinkle in the bond market, isn't there? The usual playbook seems a bit off.
Yeah, this raises a really important question. So you've got gold surging, right, the safe haven, and crude oil is falling on global growth concerns. That's pretty standard. But the U.S. 10-year Treasury yield, the benchmark borrowing cost, it's actually slightly higher, around 4.29, 4.30%.
Which is counterintuitive in a risk-off move.
Exactly. It sort of suggests that bond investors might be more worried about the long-term inflationary implications of, let's say, politically compromised Fed. A Fed that might struggle to keep prices in check down the road. So they're demanding a higher yield now for that perceived new inflation risk.
Yeah.
It's quite nuanced.
Okay, so amidst all this macro fear, this gloom, our sources are also highlighting a really strong counter-narrative, which is pretty impressive corporate earnings. It almost feels like, two different stories playing out.
Absolutely. While the broader market is clearly defensive, you look at individual companies. Bank of Montreal, BMO, reported adjusted earnings that beat the consensus forecast by nearly 10%.
10%? Wow.
Yeah, and its stock was up almost 2% pre-market. And similarly, Candler AS saw its first half revenue triple. So this creates what you might call a difficult tactical dilemma for investors, right? You have these strong company fundamentals clashing head-on with these powerful, kind of unprecedented macro headwinds.
So just to sort of recap, what you're seeing is a market really grappling with these novel political risks, geopolitical tensions. But at the same time, many companies are, still delivering pretty strong results. It's a real tug of war.
Yeah, and if you connect this to the bigger picture, that buy the dip mentality, the one that supported markets for quite a while.
Yeah.
Well, it's facing maybe its most significant challenge yet, because the nature of this shock, this political and institutional shock, it's new. It really tests market conviction in a way we maybe haven't seen for some time.
So, what really stands out to you as we wrap up this deep dive? Maybe something for you, our listeners, to consider is this. How much does our confidence in the independence of key institutions like central banks, how much does that truly underpin the stability of the whole global financial system? Definitely keep an eye out for NVIDIA's earnings on Wednesday. That'll be big. And the PCE inflation report on Friday, that's the personal consumption expenditures number, the Fed's preferred inflation gauge. Those are going to be crucial next chapters in this whole unfolding story.